From the morning reading, spiders, diamonds, Qs forming bull flag pullback. 8 of 9 sectors moved lower on Monday. XLU, XLP, and XLY were the strongest sectors, while XLV was the weakest sector. Oil futures rose $1.03 to close at 33.87. Breadth weakened as advancers led decliners 1.1 to 1 on the New York Stock Exchange, and decliners led 1.19 to 1 on the NASDAQ. Spiders, diamonds, and Qs pulled back on Monday and are forming a bull flag pattern from a higher high to a higher low as of today. IWM also pulled back but was the strongest broad market segment today. On Thursday, the spider broke out of double bottom resistance at 194.58 on February 1st with a 6-week chart target of 208.07. Today's pullback appears to be the test that we would expect to occur about 70% of the time. When the S&P moved to a new one-month high, most stocks didn't follow. Late last week, the index hit its highest level in a month, but fewer than a quarter of the stocks in the index also reached new one-month highs. That seems awful tepid, but it's about average since 1990 when stocks are coming out of a low. The participation of stocks at new one-month highs has not been highly correlated to future returns in the index, suggesting this is not a big worry. Margin debt continued to contract in January along with stocks. Looking at the year-over-year change in debt versus a change in stocks, we're not yet seeing any sign of excess pessimism, just as there was little sign of excess optimism near the peak, unlike 2000 and 2007. Investors keep pulling money out of mutual funds as well. Equity funds suffered the 10th month in a row declining assets, amounting to nearly 1.5% of assets. That's the most since 2012, but still well off previous extremes. Optimism in the most popular retail ETF has reached a record high over a 10-day period. It should be taken as a sign of pent-up buying demand if the fund can hold up over the next 1 to 2 weeks. Optimism has also taken hold in high-yield bonds. The 10-day optimism index on HYG is above 80 for the first time since July of 2013. Of the 4 times it has happened in the fund's history, 3 led to multi-week declines. The 4th was at the dawn of the new bull market in April of 2009. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:33 a.m. Central Time, and I'm recording this in preparation for the market day of March the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and go to the morning report, and we did have another one of those mornings, so pretty significant overnight activity. At the time of this cut, the S&P futures were up over 13 points, or nearly 0.75%. Russell futures were up about 1%. NASDAQ were up about 0.75%, and the Dow futures were up about 0.2%. Crude oil up about 1.4%. Euros down just below scratch. Bonds down also very, very little. And then gold is up about 0.5%. In overseas action, China up about 1.7%. Hong Kong up about 1.5%. Japan up about 0.33%. Most importantly, Germany's up about 1.5%. That usually has a lot of correlation with our own S&P. United Kingdom is up about 0.5%. In terms of macroeconomic reports for today, we have ISM manufacturing PMI and a whole bunch of yellow flag reports, which should not be market movers in themselves. Tomorrow we have crude oil inventories, the regular weekly time and place. And then ADP non-farm employment change. Of course, we'll have the monthly employment report out this Friday. That'll be one of the largest, most impactful reports of the month. In terms of current volatility conditions, We see short-term VIX did move up a little bit yesterday, back up over 20. Skew, though, still benign, and IV percentiles across all four are still very low. In fact, 3 of the 4 are in the lower third. With the S&P at a 34, as is the Russell, as is the Dow, and the NASDAQ at a 35. No standard deviation moves were put in yesterday on a close-to-close basis. Though when we look at the charts, we'll see that there was a little bit more price volatility just to kind of end up where it started in a little bit of weakness. We'll go to the charts right now. So let's look at the futures chart since we've had a good bit of overnight activity. And you see yesterday we did have, from a close-to-close basis, I guess we were down a bit, but we during the day ran up and then closed way down and closed near the bottom of the day. So that was quite bearish for the day. Also important for the day is that we closed back down inside this range. So we had the breakout and then had this reversal candle, and then that confirmed yesterday. So today so far, of course, we've gone the other direction. So this is bottom line. We called this yesterday where on Friday's close, it closed right on the former resistance turn support, and we called that neutral. Today, you know, we would still have to be in a very neutral stance. Do we really break up from this area, which we seem to be oscillating around and really fighting and not able to determine quite yet as to whether we've broken up or this is just a bull trap and we're going to see failure and come back down. There's a lot of mixed signs on this. I've been reading a number of different things which, you know, certainly reminded me of the fact that all this last year we'd have this range and we would come up here and we would tickle the high of the range. Sometimes the NASDAQ would overshoot just to, you know, promptly fail. And it seemed like it was setting up for another one of those look above and then fail kind of setups yesterday afternoon at the close. But then we come back into this morning and here we are, you know, we're back into the same area again. So it is yet to be determined, but right now you have to call it neutral and you have to wait for more information to get some feel for the short-term pattern. Now, one of the morning authors suggested that this was just a bull flag and that, you know, we would be looking for a confirmation at about 20 cents above the top of this pattern. Let's go ahead and go to the SPX. So in that case, if this is just a bull flag and nothing more, then, you know, we would be looking for a breakout of that bull flag at just above the top of this wick. Now, that's in close proximity with the high of this move. I would probably use an entry based on the high breakout, wanting to see it clear that area and set a new swing high as my entry before believing too much of this. Now, if you're really aggressive, you could scale in and perhaps take a smaller position and then follow it with the rest of your position. But if you just focus on nothing but the last 2+ weeks, you have a huge reversal followed by the 3 white candles, bull flag, and potential third bull flag. You know, and that's all very bullish. And those are continuation patterns. If you put it in the context of where we are and the intermediate term, it would seem that we ran up strongly up to the area of resistance, finally to a look above, but then failed, and then we're now waiting to see what happens with that. So there's a couple of different interpretations that you could take from this. A lot of authors are, frankly, on a more intermediate to long-term basis, quite bearish, and yet at the same time, the you know, as you look at our different market posture and other signals, an awful lot of those warnings have gone away, and there really isn't an awful lot of justification for being overly bearish. So you've got a case for both sides. Same thing yesterday also. The Russell had something of a shooting star pattern, which would be a reversal pattern near the top of a bullish run, and then you get this hammer variant, which would be considered probably a shooting star. I think they're more impressive when they actually gap up to the shooting star and then reverse. The fact that this one is kind of largely inside, you could perhaps even get this to be a a bit of a harami kind of in the body inside the body, but neither one of these bodies are terribly large. It's more of a hammer pattern, so we'll kind of go with that basis at this point. I'd like also for that wick to be higher, and if that wick is 2 times the size of the body, it's just barely so. So bottom line is it's a pretty neutral kind of stance at this point, and even if it was a shooting star, it would need confirmation, and we happen to know from the overnights that doesn't seem to be happening in the overnights. When you look at the futures contract, it's not confirming, and indeed it would seem to be setting up more as a bull flag pattern. NASDAQ also had been rolling over, but this morning seems to be invalidating and, you know, basically looking towards it's heading up towards a bull flag trigger. So what do the other markets that also help us understand what's going on with equities tell us? So volatility seems to be also rotating in a similar pattern and the inverse of the others, and right now seems to be setting for a lower open. Gold. Now gold seems to be a contrary signal. Right now gold is up, and you would expect that if this is about safe haven status, that gold would be down if the equities are up, and that seems to be a bit of a contrary sign. Let's look at bonds. Bonds really haven't done anything of note as of yet, so very, very neutral. So kind of mixed signals, and guess what? In a neutral kind of stance, that's what you get, a lot of mixed signals and not a lot of clarity. So until this actually breaks out of this area, we don't have an awful lot of probabilities around either theory that this is a bull trap and going to break down, or a bull flag and we're about to just take off to the upside. In terms of the daily report, let's go there, and you're going to see what I'm talking about in terms of that many of these signals, especially on the intermediate term basis, are actually quite benign right now. The market phase opinion, phase 4, looking for price patterns around that horizontal resistance. IBD status is confirmed uptrend, though the accumulation distribution score for both the S&P and the NASDAQ continue to be very, very poor. GMI index also very poor at a 2 out of 6, still on a sell signal. And then the stock charts decision point scoreboard, you see, is very strong in the short term, but very, very decidedly not bullish on the intermediate and long term. This author suggests that this is a setup for a failure of the bulls, and that the expectation would be that it would be a bull trap until proven otherwise. Position sizing opinions are at 100% and 75%. So when you take the consensus of all this together, we are a market in a very, very neutral stance, and until we cleanly break out of this pattern, we just don't have an awful lot of probabilities. You can make arguments both directions. In terms of intermediate term market posture, most of these lower areas of this report, though, are quite strongly bullish. In fact, very strongly bullish, with a weak bullish sentiment line for the intermediate term market posture. And you see the S&P up in that upper zone, as is the Dow. NASDAQ and the Russell, actually, especially the Russell, really making some make-up ground, is approaching the 80 area as well, which would take it into the very strongly bullish camp. If we are bullish, it certainly is, based on our indicator here, a very, very weak bull trend. And certainly that can be taken as a bit of a warning. Hedge warning status, we still have as threshold level 1, slightly elevated risk in the market, though, nothing in particularly scary at this time. This is not a prediction that market's going down, nor how far. It's just a recognition that there is elevated levels of risk in the market, and much of that has to do with where the VIX is. Indeed, when you look at our strategy opinions, the option income strategies for novices is that the VIX is outside the acceptable window, and that novices should not initiate new option income strategies in this area due to the expected larger than normal expected delta and vega moves. Now, more experienced traders will find that the additional premium that's to be had in this area is welcome. and they will be more prepared to take those extra adjustment moves that are probably going to be called for in this environment. You may also consider taking reduced position size and then being able to handle those extra adjustment moves even if you are more of a novice trader. So something to consider there. Cover call strategies and put selling, no change from yesterday. The conditions are acceptable, but the suggestions are that you still maintain a pretty defensive setup. 3-to-1 ratio of in the money and out of the money strikes for your active positions, a 1-to-0 ratio on low beta and high beta, and also consider on some of those positions legging in to those cover calls using conservative setups with well out of the money put selling. If you're using put selling, make sure you are scaling with the position size that you are willing to own. In terms of lower warnings, you see VIX futures up over 18, current week expected move, week out expected move at a 54. That's about it. In terms of warning status, in fact, a lot of this could be taken as very strongly bullish patterns. All 5 the risk intermarket key intermarket risk aversion indicators are flagging as risk on. The New York Stock Exchange new highs, new lows, 453 yesterday. So a lot of very, very bullish kind of signs down here. In terms of short-term sentiment, very benign on the stocks for the short term and medium term. Bonds a little bit more elevated at 8, gold at a 7, and then you see the sectors or industry groups which have very, very high sentiment that you should be watching for the potential of reversal patterns. We mentioned, one of the morning authors mentioned retail, and you know, if it can run another week or two, would certainly give quite a bit of footing. It is up against some pretty high sentiment readings. So another morning author, I think, mentioned high yield bonds. So you could see where some of these areas are starting to kind of perhaps become extended, but also if we're truly gaining momentum and energy, may also be breaking out of some of their own neutral patterns. So you could read this a couple different ways. Bottom line is, just because it's extended doesn't mean that it's going to roll over. Look for those potential reversal patterns if you have trades on in some of these areas. In the fear and greed index, pretty neutral at a 54, down a little bit from yesterday's 57. And then in terms of intermediate term market posture, we see that yesterday the XLI and also its equal weight ETF version of the industrials also showed up on the intermediate term market postures as turning bullish. In terms of sector specific market posture, you can see that we had a little bit of weakness come in yesterday compared to the prior day. Healthcare, energy in particular, financials, and even utilities, you know, has shown some degradation here in recent days. And really the 3 that are holding up the best, perhaps the 2, the telecom and consumer staples, again, defensive, that are holding up on all the different time frames with the best overall performance. In terms of percent change yesterday, materials was a big winner. Also, financials, energy, and industrials. And you see the 5-day and 1 month where we have the most consistency. Utilities, of course, has given back some of their big run-up of late with recent action. And that should be enough for today. Let's go ahead and wrap this up. As always, if you would like to get notice when hedge risk level changes, or to get notice of blog articles that are published, I published one just last week about bear funds. I think quite interesting, and it was quite interesting to put that article together. A couple of the things that came out, you might want to go to that site right there, falconglobaltraders.com/blog, and you can see that blog article. You can also sign up to get notice of when these things show up. Just roll down a little bit. You'll see this button, join our mailing list. Click that button, put your name and email address in there, and that will get you put onto the email list. We send a limited number of emails. We are not going to pound you with a lot of unnecessary traffic. Also, you will get access to a copy of the ebook Portfolio Strategy. You should find that of interest as well. You can also send through your smartphone a text to Falcon Global, all one word, to the 22828 number, and that will allow you to do the same thing. If you're on YouTube, and I expect you are, be sure to note that gear, and that will allow you to make sure that you're watching this in high definition. And then the second thing, very importantly, is that there's a button that can change the playback speed. That'll allow you to speed it up to 1.5 times, taking a 20-minute video down to about 13 minutes. And I'm just going to scroll through the rest of these as we've hit our kind of self-imposed limit of 20 minutes. If you see something of interest, just hit the hyperlink, and that will take you to additional details. Just hit pause if you need to slow any of this down, be able to see more. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the full hyperlink at the bottom to take you to the complete set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.